Thanks for joining. Thanks for joining. I tell you what, as more people log on, I will go ahead and introduce so we can make sure that we're using our guests' time the best as possible. I want to both welcome and thank Atiya for joining us. I put in the email that Tia is the owner, founder, operator of The Savvy Accountant. I really want to thank her for joining us. She's going to share with us on some tax planning things of note, just in general, but specifically in the age of COVID-19. And Atiya, I will pass it over to you and let you add whatever you wish.
Thank you. So I'm happy to be here. So I just put together a presentation on, I'll share my screen here. Oh, I need you to allow me to. But I'm happy to be here. My name is Atiya. I'm the owner of The Savvy Accountant, and I'll get into like my background a little bit. But I just wanted to essentially present some topics on what like COVID is doing and how it's impacting people. So I will share my screen. And so yeah, if you guys have any questions throughout, I talk pretty fast, and so feel free to stop me at any time, or you can like just raise your hand for questions. It's pretty informal. So I'm just going to go through my presentation. And so I'll give a background about myself, and then the way I structured the presentation is I'm going to kind of give definitions, and then how COVID is impacting everything, and then kind of my best practices and what I think and how everything should kind of flow. So my background, I'm originally from Montreal, Canada. A lot of people, I don't know, a lot of people know that, but I'm Canadian. So I got my license in Montreal about 13 years ago, and then I moved to the US shortly thereafter with my husband, and then we had our family here. And then I had to do the reciprocity exam to get my CPA license in the US. And so I started in public practice, and so I worked at KPMG for about 5.5 years. And then I moved into the private industry, and I worked at TD Bank for several years, about 7.5 years at TD Bank. And then I moved into the government sector, and I went to work for Utilities Commission in Florida. So my husband's job moves us around a lot. So right now I'm a Canadian girl in South Jersey. A couple months ago, I was a Canadian girl in Disney World. So that was pretty fun. So today I'm just going to talk about tax planning. And I want to basically preface that tax planning, there's nothing wrong with having a strategy in order to avoid paying taxes. I don't want you guys to confuse tax strategy with tax evasion. Tax evasion is the legal practice where you are illegally withholding funds and hiding funds so that you don't have to pay taxes on it. Tax avoidance is actually using the tax code for what it was made for. It was written as code to help taxpayers like yourself implement these strategies so that you can actually reduce your tax liability legally. And so that's what I want to talk about, and I want to get you guys in the habit of understanding the difference with the tax planning and what that means. And so I like to start off with a preference of tax planning versus tax preparation and what the difference is. So I want you guys to think of timing and savings when you basically want to understand what you're doing. So a lot of people have tax professionals that they work with, and they kind of work with them once a year. And so think of the timing. So are you working with your tax professional once a year, about March, April, and you kind of go to them with everything that happened the previous year, and you have them compile your tax return and file it for you. So that's really tax prep. And so what that is, tax prep is really the compilation of your tax return. So it's the compliance piece. So it's really just taking everything that happened in your situation from the year prior and putting it where it needs to go. So the compliance is really ensuring that you file your accurate return, you file it timely, and that the return is correct. So that's the compliance piece. What tax planning is really looking at strategies that are created into the code and going through those strategies and figuring out the best way for you to actually reduce your savings. So tax strategy or tax planning happens throughout the year. It's not a one-time thing. it's hopefully you're working with your tax professional throughout the year to figure out the best ways that you can actually reduce your taxes when it comes time for you to file at the end of the year, which is for like in the new year. So that's a difference that I like to bring up, because a lot of people think that their tax preparer is really their tax planner, when that's not reality. In reality, you go to them and they kind of just input what has already happened, whereas tax planning is kind of coming up with the picture of how you want it to look, and so that the situation at the end, you know the outcome, so you're not surprised. So I wanted to talk about some changes that happened in the tax code lately, and then we'll get into the changes that COVID brought. Because so as you guys are probably aware, we had a whole major tax reform happen, and this was the first time in my lifetime, and a lot of people that I work with, the first time in their lifetime. It's about 38, 40 years where there was such major changes. And so some of the major impacts were the standard deduction, personal exemptions that you guys were probably used to. The SALT, that's a major deduction that a lot of people were used to getting in the past, and there was a cap on the SALT. The ACA mandate, which a lot of people call Obamacare, the Affordable Cares Act, that mandate, that was actually repealed with the new tax reform. Alimony is another big one that a lot of people don't talk about, but alimony was the big one with the new tax reform on who it impacts and how it impacts them. So essentially the standard deduction, they kind of doubled it because they wanted to get away from you doing standard, you doing the itemized, because in the past you could do itemized or standard and you would do the one that was most beneficial for you. And so that's a planning and strategy in itself, because you have to basically figure out which one's better for you and then, you know, apply the one that's going to give you the best tax savings. And so what the government did with the reform is they kind of doubled the standard deduction with the hopes that people would more likely use the standard deduction as opposed to doing itemized. So it would make for easier returns to get done, because if you're just going to automatically do the standard, there's not as much calculations that have to go in there. And so that was what they did with the standard deduction. So that was the major change with that. SALT, so state and local taxes. So what that is basically if you live in a high tax state like New Jersey, California, Connecticut, New York, one of the itemized deductions that people typically took was their property taxes, or their sales taxes if it was higher for some reason. But property taxes was a major deduction that people would take when they were itemizing. And so with the new tax reform, there was a cap on that of 10,000. So that really impacts the high tax states because there's a cap. So if you pay $12,000 in your property taxes, you were able to get that deduction in the past, but you are no longer able to get the full deduction now if you hit that 10,000 limit. The ACA mandate, like I said, it was actually repealed. So you no longer have that penalty. So what that means is you used to have a penalty if you didn't have the coverage under the old system, but now that was moved. And alimony, well, essentially alimony in the past. So if you have a divorce on the books prior to the tax reform being implemented, whoever paid alimony would get a deduction. Whoever received alimony would have to include that in their income. And so I'm talking straight alimony for marriages that end, not child support. But now with the reform, that was basically removed. So as you can see, one side is benefiting more than the other because you no longer get the deduction and one side no longer has to include it in income. So of course, if you include it in income, you have to pay taxes on it. So that side is probably the happy side in that scenario. But let's talk about terms and what it means for your taxes, and then I'll get into some examples after. So income types. So there are a lot of ways that the government taxes people on the income that they make. So, but these are the different income types that exist. So there's earned income. That's what you get when you work at a W-2 typically. Your business income is when you have a business and that income is coming in. And there's different ways that that's taxed depending on the business that you're in. Rental income. Rental income is basically when you have a property, you own real property and you rent the property out. So you have tenants in there. And so you're technically a landlord. Then you have interest income, dividend income, capital gains income. And these are all taxed differently. So these are all income sources that you can have, but these are taxed in different ways. So the rates are going to be different on what you actually pay taxes on. And illegal income. So I like to mention this in my presentations because a lot of people don't understand that the government, the government is really interested in the income that you bring in because they want you to pay your fair share of taxes on that income. So illegal income is still expected to be claimed and taxes paid on that income. because they want you to look at it as it's two separate houses. So it's not the same as you committing these crimes and creating this income and then going and taking yourself to the police department to turn yourself in. What they really are concerned with is you paying your taxes on this income. So a lot of the major crime boss families, and they go to jail for actual tax evasion. So not paying their fair share taxes on the income. They don't go to jail in most cases because of the crimes that they commit. And I'm not here to talk about the crimes or anything like that, but I'm here to tell you that the tax evasion piece is very serious, and you will go to prison for that because they take that very seriously. So illegal income does have to be claimed on your return and filed. So now that I talked about income and you guys understand the different sources of income and how they're taxed, I wanted to talk about unemployment income. So with the coronavirus, the government has granted relief in different forms. And one of the ways that they granted relief was unemployment. So they were able to extend unemployment for people that had to, take leave from their jobs. And they also were they gave an additional funds for each person that was on the unemployment. So I want you guys to be aware of something that you need to be planning for is unemployment income is taxable income. And just like I was talking about earned income, you have to look at it from the premise of what is this income supposed to be? And because your earned income is taxed and it's taxable as the rates from the 10 to 37% tax rates, I'll show you those rates in a little bit just for context. You have to think the parallel is that the unemployment income is also taxable. And so that's going to be taxed as well. And so that's going to be flowing to your tax return when it comes time to file. And I know a lot of people are going to be hit because they didn't adjust their withholdings for their unemployment. So they were getting this unemployment and they aren't realizing that this is still taxable income. So in a lot of cases, because of the relief that the government gave, a lot of people were actually making more on unemployment than they were at their job. And so obviously that's going to be, exciting for some people. But aside from the fact that we were in the middle of a pandemic, and so they needed the extra funds because times were very hard and these were unprecedented times, the fact that they were getting more income should be an alarm that they need to withhold taxes from the unemployment. And if it's too late for that, they need to be saving, because when it comes time to file their taxes, when this income is actually adjusted to and it's added to their return, they are going to have to owe more taxes than they anticipated, than they typically do. And so they need to make sure that they're actually ready for that situation, for that scenario when it comes due down the line. So unemployment income with the relief that came from the government is taxable income. And so you need to be aware of that as like a tax plan of how you're going to be prepared for that when that happens. So I like to talk about the taxes and how things are taxed. And so we talk about the different income sources. And so you're going to have your income taxes. So there are different ways that the government's going to tax you. Your income taxes, your self-employment taxes, if you have a business, capital gains tax, that's going to be taxed differently than earned income. So capital gains, the rates are a lot more favorable than earned income. And so most of the people in America that have capital gains, they fall into the 15% tax bracket, whereas the income bracket goes from 10 to 37%. So as you can imagine, just by doing the math on those numbers without any other numbers, 37% versus the 15%, you're going to have a lot lower taxes if you fall under the capital gains. So the earned income is going to be taxed the harshest, I guess you can call it. There's sales tax, property taxes, payroll taxes, estate taxes, Essex taxes. So there's so many different ways that the government taxes you, and it's just about knowing where you fall in order for you to anticipate how you can plan for it. So this brings about another topic of a planning opportunity. So payroll taxes, what are payroll taxes? So payroll taxes are when you work at a W-2, or if you're an employer and you have employees that work for you, you should know about payroll taxes as well. But so it's basically made up of Social Security and Medicare. And so what it is the employer's responsibility to collect these taxes on behalf of their employee and send it in. So when you look at your withholdings on your payroll check, that's what your employer is doing. They're sending this withholdings on your behalf to the government throughout the year, because the government works on an earn and pay system. So as you earn income, they expect you to pay taxes on it. And so as you're an employee, a good thing is that you actually satisfy that. You are paying throughout the year. But when you're a small business owner or a contractor working for yourself, you don't have the luxury of that withholding being done for you. So what you have to do is submit estimated taxes. So 4 times of the year, the government expects that you calculate what you should be owing throughout the year and submit those 4 times a year. This payroll, during the coronavirus, the government has initiated something called payroll tax holiday. And so what this is, it's not a tax break. People need to understand that it's just a deferment of this tax. So because it's the employer's responsibility to withhold the taxes, the government has given the employer the choice if they're going to do this or not, because there's a lot of factors to come into this. Most employers have a payroll system. The payroll system is pretty automated in the way it works. So in order to put this holiday break in there, there's going to be a lot of system changes that have to happen. So most private employers most likely won't implement this. They might ask their employees, they might poll their employees and see if they want to do it. So what it is, it's basically saying that half of the payroll taxes, they're being deferred until next year. So what it is your paycheck is going to look heavier. Your take home is going to be higher. But in the following year, it's going to be doubled up. So you're going to have to repay that back because the tax holiday is going to be over. And so a lot of employers might opt not to do this, because think of the situation if an employee leaves, it's still on the employer to pay these taxes back. So the employer would be on the hook for these should that employee leave and they're not able to do that to catch up. Another situation is that people need to understand that this has to be paid back. So your check is going to look bigger for the end of this year, but next year it's going to look smaller. And so you have to be prepared for those differences. And so what I suggest is, if your employer does do this and you are impacted by this, you need to look into saving those extra earnings, saving them in an online savings account so that you can earn interest a lot faster, because online savings accounts tend to have higher rates than the traditional bank. So if that's your situation and your employer kind of forces this on you and you don't have a choice, you want to basically plan and make sure that you're able to pay this back, and there's no issues with you having to get extra money and then spend extra money, but having to actually repay it back. So that's something that I think people need to be on the lookout for and how they should plan for that. Unfortunately, if you're a government employee, you don't have a say in this, because the government did not give them a say. Let's talk about deductions next. So deductions, basically, I talked about some of them a little bit earlier, but they reduce your taxes when you're an employee, like a W-2, and you fall into the marginal tax rate. They reduce your tax liability by your marginal tax rate per dollar. So they're not going to reduce 1 for 1, but they're going to still reduce your above the line before your tax liability is calculated. So the examples of deductions that we talked about was the standard deduction, that's SALT deduction. You have interest deductions, you have medical expenses, charity. These are other deductions that you could be applying to your income to reduce what your tax calculation is going to be actually calculated on. So just talking about deductions, I wanted to talk about 401k retirement plans in this area. So with the coronavirus, one of the reliefs that were given was that you're able to take funds from your retirement account. And so typically, if you are not at the age of the withdrawal, you have a penalty. And so what the relief said was that you're able to take out up to $100,000 and they're going to waive the penalty. And you have 3 years that you're going to spread it out over your income. So I'm going to talk about the difference between taking the withdrawal and taking the loan. So with the first scenario, with the withdrawal, you don't have to pay it back. Obviously with the loan, you're required to pay it back, and the terms are going to differ depending on your employer and the plans that they have, but it's typically for the loan was typically over 5 years. With the coronavirus relief, you're able to spread out the income over the 3 years. So while the penalty is waived, the 10% penalty that you have, while that's waived, the income tax piece is not waived. So you still have to add that to the income and spread it out over 3 years. So let's say you took $9,000, you're going to report $3,000, $3,000, $3,000 over the next 3 tax returns. And that's how the income taxes is going to be allocated to it. The 10% penalty is waived in both. So you're going to have the penalty waived by the early withdrawal. So that's not going to be there. And there's no penalty for the loan piece unless you can't repay it. So typically the way it works is if you get the 5 years and you can't repay it, then that's where you're going to be slapped with the penalties and interest, because it's going to essentially be like you did an early withdrawal as opposed to a loan. And the next topic is going to be it's taxed as income. So in the first scenario, when you take the withdrawal and you spread it out over the 3 years, the income, and you get taxed in that sense, if you're able to repay it back, and you're able to repay it back over the 3 years, like if in year 2022, you're able to repay back that $9,000, you're able to amend your tax returns and get that refund for what you actually paid extra income, because now you put it back into your retirement account. So that's a tax planning strategy where you guys need to look at. So if you do take out this withdrawal and you spread it over 3 years and then you're able to repay it back, remember that you're able to go back 3 years of your tax returns to file an amended return to get those refunds back. So 3 years is the magic number. Even before the coronavirus happened, so I like to tell my clients when I'm doing a tax plan, we always look at the past 3 years of tax returns, because you can always go back 3 years and see if anything was done wrong, any errors that can be amended, that you're due a refund. So the government allows you to get a refund up to 3 years. And so that's why the magical number of 3 is there. And so that's the retirement plan. So I did see something flash on my screen, and I don't know.
So we had if you have we have
yeah, I can pause. Yeah.
Cool. So we have a government employee who asked, since they're asking, would you suggest doing the savings in an online account as well in terms of the taxes? But I think you kind of answered the question. But
yeah. So I definitely would recommend they do it, because what that's going to do, it's going to act as a buffer for you for next year when your paycheck is lighter. And so you want to make sure that you can do that. And the reason I always suggest savings in online savings accounts is because their rates are a lot higher than traditional banks. And then they used to be a lot higher, like last year or the year before. They've kind of come down a little bit, but it's still not 0.01%. So it's still better bang for your buck. And, you know, they don't have the brick and mortar. It's harder for you to get your cash out. So it's easier for you to save. So if you don't typically get a debit card to go with those accounts. So, you know, if you're going to do one of those spur of the moment spending sprees, you can't really do it with those funds. So it gives you time to go home and think about it. Do I really need to buy whatever I wanted to splurge on? And, you know, I think it's like 8 out of 10 times, once you don't make the purchase at that point, you actually won't end up making that impromptu purchase. So.
And I had my own question since we stopped for a question.
Yeah.
For these, if you're taking this retirement plan distribution, do you have to prove that you've been impacted by coronavirus? Can anybody do this? Like what?
So those are good questions. So that's a good question. So I have to say that the background behind this was not very stringent. And because coronavirus was such an impact, a lot of the laws that were impacted, they weren't like, it just happened so quickly. So the terms behind this early withdrawal are very lenient, in my opinion. Typically, like in the past, taking out a 401k loan was, you know, kind of like taboo. It had to be done at the right time. You need to make sure, was it for you to buy your first home? It was very strict. This is very lenient. So it's not like you have to have corona. So you essentially just have to prove that you were impacted. And it's kind of like everybody was impacted. People had to stay home from work, schools were closed. So your proof of being impacted, in my opinion, is not hard to prove. With that being said, I still don't fully recommend that people do this as a first option. This is still a last option for me, because I'm very strong on paying your future self. And I do think that this is still, while it's helping you today, if this is not the last resort, I wouldn't do it, because I feel like it's still taking away from your future self. So while you're able to, you know, have the penalty waived and spread it out over 3 years, it's still money that would have been accumulating for your future, that you now are going to have to either catch up on or figure out a way to replace it, because you're still going to need money in the future. So it's still not a first resort for me, even though, like I said, it's not as it's very lenient in what is going to be qualifying you as impacted by Corona, and it is there. So for some people, it is the like they are at their last resort, and it's the fact that they have this as a buffer is something, it's a blessing. So it's just not my first choice, if that makes sense. So moving on, I just talked about deductions. So let's talk about credits. So credits are more favorable in the tax world. So credits, what they do is they reduce your tax liability dollar for dollar. So credits are different from deductions because deductions happen above the line. So think of it as like a pyramid. So you have your income, then you put your deductions. Then when you get that net amount, that's where you calculate your taxes, your tax liability on that. And so you want those deductions in there. But then after you calculate your tax liability, now is when you apply credits. So it tells you you owe $10,000 in taxes. Well, now I have to apply my credits. And so that $10,000 is going to get reduced further. Credits, we have non-refundable credits and we have refundable credits. Most credits are non-refundable, but there are some refundable credits. And, you know, refundable credits are what they sound like. They can generate a refund for you. So non-refundable credits essentially just mean that they're going to be applied until you basically you run out of what your liability is. Whereas refundable is going to apply until you use that actual credit. And so just some common examples of credits: child tax credit, there's earned income credit, there's education credit. There's a few education credits that exist. Some are only for post-secondary and you can only use them for 4 years. Others are the lifetime, so you can get them annually as long as you're in an education program after secondary school. But I just wanted to talk about credits. And since we talked about credits, I wanted to talk about the stimulus check. And so the stimulus check is a credit for 2021. And so a lot of people were confused and they didn't understand what was happening with the stimulus check. But what it is the same way I just explained above of what a credit is. The government basically is saying that when you would have filed your tax return in 2021 for your 2021, they created this credit for you because of the coronavirus. But because we were having coronavirus happen to us right now, what they did was they gave you an advance of this credit. And so they just basically sent it to you in advance because, you know, waiting for when you actually file the 2021 return, that it would just be too late for you to get that credit. So it's an advance. And I know because the terms mean typically when you have an advance, it just means like a loan and they're giving it to you in advance and you have to pay it back. That's not what this credit is. You don't have to repay a credit. The word advance is just that you got the credit in advance of when it was due, because the credit was technically supposed to be for the 2020 year, which you would file the 2020 year in 2021. So it would have just been way too long for you to wait till April 15th, 2021 to get the credit. And so that's what the stimulus check is. So it's not a loan that you have to pay back. It is a credit and it's acting like a credit. It's acting like a credit would if you did the credit in the year that you were supposed to be due the credit. They just sent it to everybody early because we were experiencing the hardship now. So I just wanted to talk about that, and I don't know if anybody has any questions about that. So I did say that I would show you guys the tax rate and how everything works. So this is typically how it works so it's 10 to 37%. These are the buckets that you have to fall into. And here's where I was talking about the capital gains tax rate. So you see that the majority of Americans are going to fall into the 15%, because if you make under the 441,000, or 20%. But even if you sold property or sold an asset and your gain is 450 and you are impacted by the 20% is still better than if you made 450 at your employment. So that's just the difference with the tax rates and how they actually are applied. And finally, I'm going to talk about refunds really quickly, and how a refund is typically generated and what it means, and the difference between the withholdings and the estimated taxes I touched on a little bit earlier. So when you're a W-2 employee, your employer withholds the taxes from you. And what that typically means is you're sending it in throughout the year. When it comes time for you to file your return, you essentially are truing up what you should be sending in versus what you actually sent in. And that's the difference. Like in a simplified case, that's the difference of what you're going to owe on April 15th or what you're going to get back. So if you are getting back a huge refund every year, and it's not because of a refundable credit. So remember we talked about credits and how they can generate a refund for you. If you're getting a huge refund every year and it's not because of a credit, so that's a different scenario. But it's because your withholdings were too high throughout the year. I don't want you to get excited about that refund in that scenario. What I want you to do is to go to your employer and make sure you adjust your withholdings so that they're not withholding that much throughout the year, and then you can have that in every paycheck. Because what it means is that you sent the government too much money throughout the year. They held onto your money interest-free, and they're simply returning it to you. So when you get these refunds, there's no interest applied to it for them holding your money for that long. But if you owe them money, there's going to be interest applied to it. So if you are getting a huge refund every year, and it's not because of a credit, you need to make sure your withholdings are adjusted. And similarly, if you are in the same scenario, but you're a contractor or self-employed, and you are sending in estimated quarterly taxes, and every year the true up is different, you just need to basically make sure that you're adjusting your estimated tax payments. And I like to tell people that the parallel is the withholdings are parallel to the estimated quarterly taxes. One is you complete the W-4 at the beginning of the year with your employer, and then they're going to issue you a W-2. In the other scenario, if you're a contractor or you're hiring contractors, they're going to complete a W-9 for you so that you can give them a 1099, and that's going to be what you show what you paid them at the end of the year. Somebody had raised their hand, so I can take, I don't know how the raised hand works, to be honest, but I guess she can talk, or
I'm trying to see whose hand it was that was raised.
oh yeah, because I can't see that. I don't see who it is anymore. I just saw that somebody raised their
Okay,
hand.
I see it. Let's see. The question that we have is, how do you figure out how much you need to ask your employer to withhold? Do you base it off of the year before? Is there a calculation involved? I'm a single woman with no kids and no property, and I get taxed pretty high.
That's a great question. I touch on it on my last slide, but I'll touch on it now. So the government, the IRS website, so irs.gov, that website is very old. It's been in existence for a long time, and it's very archaic, but the information is there. So if you go to irs.gov and slash withholdings calculator, what they did was they created, and this is new, so the calculator did not always look this pretty, but they created this calculator that you can actually go to and you implement all your information. So you're going to be taking your pay stubs and some prior year information and some current year information. So if you have a side business, you're going to want to factor that in as well. But you can go to this calculator and input everything, and then it's going to tell you what your W-4 should look like. And then that's what you would take to your employer to compare it and see where that is. The reason for this is because with the new tax reform that happened, they changed the way that they did withholding. And so most people don't know that. So when the tax reform happened and the first tax year happened, a lot of people were, rudely surprised by them actually owing more because their withholdings weren't enough. So the old withholding system was based on exemptions, like how many dependents you have and stuff like that. Well, that's not the case anymore, so they don't have that anymore. So if you didn't change it, the way that the payroll systems typically reverted, it didn't revert to how the new W-4 is. And so your withholdings basically stayed the same. And so a lot of people were surprised by that because they didn't realize that they had to adjust their W-4s. So there is a calculator. I can get it out like by email to you guys after, so you guys can go there, but it's a very user-friendly calculator. I can tell you guys right now, it's probably one of the first user-friendly things that irs.gov has put out, so you guys should take advantage of it. So that was a good question. And I think next I was just going to talk about some dates that you guys need to be aware of. So this is typically just deadlines and due dates. Yesterday I had a pretty big deadline with S Corps and partnerships returns that were extended from March. Those came due yesterday, so that was fun. And we have the extension for personal taxes or C Corp. So if you're a C Corp or your personal tax and you extended them from the July date, now those are going to be due October 15th. So these are just some dates that you guys should be aware of and how you can actually plan for them. And so, like I said, irs.gov is a great resource. It's a free website. It's hard to navigate it, but all of the information that you need regarding taxes is going to be there. It's just, it might take some time to look at it. Cloud accounting for tracking, I typically recommend that organization is always going to be your friend when it comes to taxes. So when it comes to dealing with any tax issues that you guys have, you need to be organized. You need to make sure that you stay on top of whatever is being sent to you so that you can tackle the situation at hand. So many times I find people are stressed because they got a notice and they let it linger because they don't know what it means. And so the best thing I can say is to speak to a professional. Even if you guys don't have to work with a professional, it's always better to speak with them to see what your actual options are and to move forward rather than sitting on it, because what I can assure you is that the IRS does not go away. So if they send you a letter, it's because they've tried to reach you and the process is starting. So they're going to send a few letters before things start getting worse, and it's kind of going to escalate. I don't say that to scare you, because most tax problems can be taken care of. You just have to get in front of it and understand what's being requested of you. But no tax problems go away by ignoring them. So I just want you guys to have that in your back pocket so that you understand how to deal with tax issues, how to make sure that you're planning accordingly. And I am happy to open the floor for questions if you guys have any questions right now.
So while I give them an opportunity to type any questions that they might have, and so you guys know, Atiya, she just skillfully answered some of the questions that you guys had already submitted in her presentation, so we didn't have to cover in a separate session. Just in case somebody has some. So we actually had two that were submitted after I sent you. The first we have is, are you taking new clients? That's the first one.
I am. So I don't know the best way to send it. I can send Brenton my contact information. I had it on screen, but I turned it off.
Okay, so I will make sure that in the recap email that goes to you guys that we have all of her contact information. That was the first question we had. Okay. The second question that we had that came in after you and I talked, I guess it was yesterday, was a lot of the people on our email list, they have significant student loans and they are aiming to have them forgiven. Some of them are being forgiven under the Public Service Loan Forgiveness Program where they won't have to pay taxes on it. But some of them are worrying about, okay, what if 20 years from now I have $400,000 worth of student loans forgiven? So let's say that somebody has those amount of loans forgiven, they get a huge tax bill that they can't pay, $100,000, $150,000 tax bill. How does that work? Are there payment plans available? You know, are they going to come knock on your door? That's the question we had.
Okay, so when loans get forgiven, typically the way it works is the government looks at it as, okay, you had this huge debt that you no longer have to pay. So in most cases, they add it as income in a sense, because they say you no longer have to pay this. So it's kind of like we gave you income. It's kind of like a backwards way of thinking. So when you do have loan forgiveness, you do have to worry about that inclusion of income. And so it does generate a tax bill sometimes, but large tax bills can be handled. And so like I just ended with saying, there are different ways to handle it, but always you need to handle it. So we can work on an offer for you. So that's something that we handle at my practice. So we handle what offer you're going to be able to make. And typically people are surprised that it's not what they think that it should be. So in most cases, it's a lot lower than what they were expecting. So working with a professional always works in your favor. On top of offers, there are definitely payment plans and installment plans that you guys can work out as well. But there's always something that you can do. So seeing that huge number, I know it's going to give a lot of people anxiety, but don't let it freeze you. Like, don't let it get you stuck, because then it's just going to get worse.
Right, right. Okay, and then the last question that we had that came in after, unless you guys who are on the call live have extra ones, is someone asked, and I'm glad that you touched on the difference between somebody who's preparing your taxes and someone who's strategizing for taxes. And a person actually asked, how do you know if you're in a position where you need someone to help you strategize? And this person was a W-2 employee. So they're just wondering, how do you know if your tax situation is complex enough that you could benefit from tax strategy?
Okay, so here's what I like to tell people. W-2 doesn't mean that you don't need strategy, because there are definitely things that you can do as a W-2 employee that is going to basically help you reduce your liability. What I like to tell people, and it's kind of how I start, is if you owe taxes, any amount of taxes, you probably can use a tax strategy session, at least to figure out why you owe these taxes. You know, sometimes you're going to have to owe taxes just because it is what it is. But is there a way for us to reduce those taxes? Because even reducing what you do owe, that's a strategy. And figuring out, are you paying too much in taxes? And that's basically what we want to do. So if you have a tax liability and you want to figure out why it's so high, you probably could benefit from a tax strategy session at least.
All right. Well, we don't have any extra beyond those that were submitted. So unless you have, if you didn't have anything else to share, then we just, on behalf of our private clients, want to thank you for sharing your time with us again. As you guys know, we'll send a recap email that has both the recording of this session and then also some of the key points that Atiya shared with us. So thank you again. We'll make sure we have our contact information in there as well. And I hope you guys, oh, our pleasure. Thank you. And we hope you guys have a good rest of your evening. Have a good one.
Thanks, guys.